This year, Kennedy Investments is offering a new discretionary managed account service for a limited number of clients. Peter Kennedy is a highly experienced investment manager who is offering a new approach based on cyclical investing. This video provides a brief introduction to his unique perspective and very successful methodology.
The best time to start investing in the share market is at the beginning of a bull market. And I believe that this bull market started in July 2012, has got several years to run. And the reason for that is that you have at that point in time, you have the highest degree of certainty of rising share price. So effectively, it's easier to make money at that point than it is at any other point in the cycle. Cyclical investing recognises that there is a cycle of price performance for different asset classes over different periods of time. In other words, you need to be weighted towards different assets at different points in the cycle. Now, the asset class that's most obvious in is equities, because equities is where you're going to get really large price movements.
Whilst the idea of cyclical investing had been around for a while, Peter Kennedy decided to go back and plot the market patterns for the last 70 years. He overlaid this with the momentum indicators and found that where a momentum bias signal coincided with a low early in the decade, this was a considerably accurate predictor of the low point in the cycle.
Now that I want to manage money for clients on a discretionary basis, and I want to do that in the same way as I've managed my own money, I thought it was worthwhile to have a look back in time and see what the performance I've managed to achieve over similar periods in the market. So I picked the period 2004 to 2010 because that's a similar period that I think we're going into now. In other words, the beginning of a major bull market. And I was actually surprised at how much money I'd made.
Peter went back through the numbers in detail and found that from 2004 to 2013, a period which spanned the GFC, every $100,000 he'd invested in 2004 was worth $1.5 million by 2013, a figure later verified by a major accounting firm.
On the basis of that performance, I feel totally justified in offering a discretionary trading facility to clients. I think it's important to understand that I'm not offering to look after people's money for them, right? In a sense, if you want someone to look after your money, you just put it in the bank. What I'm really trying to do is to make money.
Peter is charging fees based on performance. Therefore, he's incentivized to maximize returns, especially as he's an investor himself. A typical fund manager, however, is paid a percentage of funds under management. Therefore, their incentive is to maximize funds, not returns. Whilst good returns may attract more FUM, this ironically mitigates against future gains, because returns generally suffer when the size of funds increase. By contrast, the value of Peter's business is based purely on the success he has investing for his clients.
This business has no enterprise value, which is an interesting thing, isn't it? So it only has value in that I can make money for clients, which I'll share. It has no value other than that. What I'm doing is I'm managing separate accounts, and those accounts are on the internet. You can go in, you can have a look at every single position that you've got, you can look at every single transaction, you can look at every single movement of cash within that account. So it is absolutely not a black box, it's totally transparent. If you have a managed fund, then somebody might have put money into that fund yesterday, so you have to treat every dollar as though it was the first dollar of capital. Whereas if you've got someone's separate account, you can actually make a distinction between capital and gains, which means you can take a lot more risk and potentially generate higher returns. There's a limit to how much money you can manage like this, and it's not really very much. If you look at a traditional funds management business, I don't know whether it's like $10 billion or something might be regarded, or $5 or $10 billion is regarded as an optimal amount, but for me it's more like $100 million. It's really about getting a high return rather than having a large amount of money under management. My approach is that I tend, and it's an inherent characteristic, that I tend to work things out from first principles myself. That's just the way I tend to approach things. And I don't tend to take on face value things that other people say or do. And I think that's quite a helpful approach to markets, actually. Of course we're taking risk, but what we're trying to do is more risk money that we've made rather than risking the initial capital. I would guess for every person that's profited out of leverage, probably 5 people have lost money through using leverage. And the reason for that is that if you're going to use leverage, you've really got to get the timing right. Right? So you can't use leverage indiscriminately and say, well, I'm going to gear into equities, say, and I'm going to hold that forever. So you've got to get the timing right, but you've also got to be able to manage risk. It's something that I think using leverage in portfolios requires quite a lot of actual experience and the knowledge and experience of using tools like derivatives and really understanding how money management works. I'll tell you something, this is really weird, but I reckon I've traded the market virtually every single day for 30 years. Do you know what that really means? That's my whole life. And that's sad in a way. It's like having a theory about golf if you've never played golf. But it's the guy that plays golf every single day is the one who's going to win the tournament, right? As you may know, there is the philosophy that it's time in the market, not timing the market, that counts. And I would agree with that if you have a long period of time to invest. But the reality is, for most of the people we're dealing with, they're over the age of 50, they're probably over the age of 55, or even over the age of 60, and time is the thing they don't have. So they've got to get the timing right, and I believe that the timing's now.